Hi, I'm Kevin Castaneda, and this is Kev's Mindset, where we talk everything finance, investing, mindset, and productivity. And in this video, we're going to be talking over why it's so important that you genuinely like the companies that you're holding, and why it's so important because of the fact that when the market starts to fall, if you don't know anything about your companies, if they were just trades, if you don't genuinely have some sort of sense that you feel like this company is going to be great, if you don't have that, there's a lot of consequences when the market starts to fall. So we're going to be talking about that in this video. We're going to be talking about why conviction is the most important thing when investing long term. So right now, the S&P 500 is not down like crazy, honestly. Big tech is holding it up, and it just kind of seems like it's perfectly fine. Like nothing's going on in the market. Let's say you don't follow the market a lot, and you just see you just check the S&P 500 here and there, and you see it's up, it's up, it's up, it's up. You're like, oh, nothing's going on in the market. That's not true. It's not true at all. Small caps, mid caps, even some large caps are starting to sell off quite substantially. We see things like Enphase down 20 to 30% off all-time highs. We see things like DocuSign down about 60% from all-time highs. We see all these companies going down quite substantially, especially software companies. We see Tesla falling from all-time highs of about 1,200 something down to under 1,000, around 960 on the day low. So we're seeing all these companies start to sell off in the fintech space, even mature companies like PayPal in the fintech space. We're seeing all these companies continue to sell off. So now us as investors look at these companies and we're like, okay, what do we want? What do we want to buy? What do we have high conviction about? And that's key, because the important thing to remember is, let's say right now you had, let's say $5,000 in the market, right? And let's say you had 5 companies, to keep it simple. So you had $1,000 in each company, and you had one company that you really liked, and then 4 other ones that were trades, or you just bought because you saw on TikTok or something silly like that. First off, shouldn't have been doing that, but this is just an example. Now, what are you gonna do when the market starts to sell off? You're probably going to sell. And it's not because, oh, you're a paper hand or whatever. It's because you don't understand your company fundamentally. You don't know if your company's doing well. So when these companies sell off and you see, okay, my company's going down, my stock's down 20%, and you don't even know what you're holding, you just know maybe it's like the basics of it, like you know what the company does. But if you don't know the fundamentals of your company, if you don't have high conviction, if you don't feel like they have a great vision, if you don't know about their management team, if you don't know their revenue expectations, if you don't know their growth expectations, you won't know if they're undervalued. You might just think that they were overvalued and now they're selling off like crazy, and they might still be overvalued. So it's very important when you're investing long term to know your companies, know why you're in it, know how long you want to be in it, know if you're okay with these sell-offs, or is this just a trade? If it's a trade, you knew it was a trade. Maybe you cut losses, whatever it is. But it's important that when you're investing, you have to know what was a trade and what's long term. So personally, I have 9 companies right now, and then I have 10% of my portfolio allocated in crypto. I know all 9 of these companies very, very well, and I also have high conviction about crypto, which is 10% of my portfolio. So each of these companies, I'm looking at them, and if they're uneven at this point, at first they were all 10% weighting compared to my portfolio. Now they're uneven. Why is that? Because some of these companies stayed up high. Things like Apple sitting at almost all-time highs. Things like Google's not selling off too crazy. Things like Amazon not selling off too crazy. Facebook is the only one that sold off quite substantially. So I'm buying into Facebook. Affirm sold off like crazy. I'm buying into Affirm. AT&T sold off not in this in the past week. It went down to the 22s. At that point, I was buying heavy, continuing to buy up more and more AT&T. Now AT&T starting to go up a little bit as people reach for safety. So I'm not buying as much of it. I'm trying to equal out my weighting of different companies. Disney went down to 142, continue to buy. Now it's back up to 150, not buying as much. So it's important that if you know your companies and you know their long-term future, if you know what they're going to do, then you'll be happy continuing to buy the dip. You'll even be okay with it being unevenly weighted, because you're like, okay, there's a huge buying opportunity for this company. And once you know the price ranges, once you know where you're comfortable buying a company, you can continue to add. You'll be okay with it being unevenly distributed, because you know, okay, at a certain point this will drop and then I'll buy more of this. But if you don't know, then you're just confused. You're lost in the market. You're scared. You lost a bunch of money and you're unhappy and you feel like you made a mistake. Then you end up selling for a loss and then you never get on the market again. Obviously, that's like the worst case scenario, but this just shows you why it's so important to know your companies. Because let's say your stock sells off 10, 20, 30, 40% even. If that happens and you know that it's a great company, you know that it's just getting even cheaper and even cheaper, and it's a way better deal now than it was a little while ago, then you can continue to buy. If not, then you're lost and you end up selling. So here's a real life example. This literally happened to me today. I was down about 16% at market open today on a firm with an average cost of about 126 or so. I look at the company and the market opens, it's 9:30. I see the stock just start diving down. It goes all the way down to like 97-ish dollars. I buy I buy the first share at about 97 something. Then I see it start to bounce up a little more. I buy the second share at 98 something. Then by the end of the day, it rallied all the way up to like 115 and it settled down around 110, 111 by the end of the day. Now, if I had not known this company, I wouldn't have bought the dip at 96. I would have probably freaked out, shut off my phone, or I would have sold, or something terrible like that. But because I do, and because I knew this was a great price for this company, I bought it, and now I'm reaping the benefits from it. It ended up being a way greener day because of that purchase of buying some more firm and loading up on that company. So this is just something simple to keep in mind. If you love the companies and you know everything about them, then you're going to continue to buy while there's a dip. If not, you might miss out on opportunities. Let me know what you think about this in the comment section down below. Do you hold only companies you love? Do you have trades in your portfolio? What's going on? Let me know. I'd love to hear it. See you in the next one. This was Kev's Mindset, and I really appreciate your time. Go ahead and subscribe if you do want to watch more of my content, and leave a like if you did enjoy. See you in the next one.